Hello, everybody, and welcome to the Dash Trader Newsroom. This is the earnings season trends and market correction report. Market has bounced off of correction territory. Let's see how far this market will go. My name is Michael DeGioia. I am the Director of Educational Services here at Dash Trader. I'm a licensed professional. And let's jump right in and talk a little bit about the financials first. So the whole purpose of today's Dash Trader Newsroom is to kind of go through the earnings reports on a sector-by-sector basis. The first sector that we're going to be dealing with is the financial sector. Namely, we have JP Morgan, Citigroup, and BAC. The charts, I'm just going to do my laser pointer here. The charts are showing here on top is JP Morgan. You had a bit of a bull pennant that got long in the tooth, then gapped down, continued down, did a gap fade and basically faded back to the area that it gapped down to, and then continued to fade and fill. BAC and Citigroup pretty much have the same chart. This one is Citigroup, but BAC looks similar. We'll take a look at that in a little bit at the market analysis section. But needless to say, Citigroup pretty much recouped all of its losses from its less than stellar earnings report. Now, what was in the actual earnings report is that that they met earnings expectations. They beat earnings expectations on revenue, but they had extraordinary trading revenues. But they also guided down going forward, saying that the environment for banking is less than favorable. Other things that really hurt the banking sector are the interest rates, right? We're kind of toggling back and forth. Are we at a soft landing? Are we in a not so soft landing? Is the soft landing here? Is it coming? What is the case with inflation? But the main gist of it is that higher interest rates hurt bank revenues, especially in the area of refinancing loans. The interest rates have gone up to 7% on loans, on mortgages, and that basically makes it very unlikely that people who finance their home at 3 and 4% are ever going to refinance at these rates. So all you really have are new home buyers, and of course, with higher interest rates, it's less likely that people are going to be buying homes because the homes are much more expensive to be financed. Banks got hit hard on this latest GDP number, and they got hit hard on their earnings reports because of the reducing of forward guidance. So this is something I would say that the banking sector overall has probably peaked for the short term because of this uncertainty related to interest rates. It's really hard to have a steady growth, and really banking underlies all other sectors, including tech, which is what we're going to talk about next. So next, we're going to cover the tech sector. This is Netflix. Netflix is the start of the online streamers. You got Disney, which kind of comes in late in earnings season. You got a couple of other plays like Roku, etc. Needless to say, Netflix beat earnings expectations, but they said they would no longer be reporting on subscribers on a quarterly basis. Now, this was a number that everybody always judged Netflix by. So that change in their reporting policy was taken very negatively. And you can see that by the way that Netflix gapped down. So we really have what's kind of a rounded top here. Some might say that this is an island top reversal, potential shoulder, head, and shoulder. Now, what you are going to see is that there are a lot of these head and shoulder type patterns, shoulder, head, shoulder, kind of a head and shoulders here, but then it kind of negates the head and shoulders on the recent rally. So you've seen it in the banking sector, and you've seen it in the tech sector. So this was taken negatively on Netflix. Now let's jump into the meat and potatoes of the tech sector. Here you have Meta. Meta has been on fire. It's done incredibly well up till this earnings report. It kind of got its head chopped off a bit. It gapped down into the gap that it created with its last earnings report, which was stellar. But now you kind of have this gap up island. Meta beat due to higher than expected. Meta beat, but due to higher than expected AI spending, Meta was down, which weighed down the markets as well. So now what you're seeing is that, what's been going on at Meta? Meta had this big expenditure of creating the metaverse, right? Where it's kind of this online universe that kind of bombed. They kind of, picked up and did very well with, kind of their anti-Twitter X platform, Threads. You have obviously, WhatsApp doing well, Facebook, that's why they call it Meta platforms. But the problem is that Meta has had to spend a tremendous amount of money on AI, and they haven't really gotten any of the benefits yet from AI. So Meta's in a little bit of a tight spot, but this is not just Meta's problem. The other chart we have here is Big Blue, which is IBM, and they also had to spend a ton of money on developing their own AI systems, and of course, Meta had to pay a huge fine by the European Union. There's all kinds of new regulations going on in the tech and AI space. And there's all kinds of antitrust, litigation that's all over the place. So you have technology in general facing more regulation. This is something we talked about in one of our prior episodes, is that AI development costs as well as regulatory costs have really increased the cost factor across the technology sector. Let's jump into Tesla, because this is another one of those really interesting sectors that have fueled the recent rally that we've had since October. Tesla kind of, got a little tarnished sooner than the others. It really did not benefit so much from AI. Tesla is a bit of a different story. Its revenues have fallen 9% from last quarter. That seems to be that EV demand is drying up. It has seen demand dry up for some of its models. And the main model that it's kind of a beetle-shaped, lowest, most affordable model is the one that seems to have seen the biggest fall off on demand, and it laid off 10% of its workforce. They do plan. Elon Musk did manage to kind of get the stock to recover a little bit by promising to make an even more attractive and affordable EV cars by 2015. So they plan on releasing some new model. The big problem is that their mainstay model, is kind of lost its attraction, and it's kind of become common. It's no longer the thing to have, so to speak. So Tesla's kind of facing that lack of demand. Now, remember, you also have to understand that Tesla really benefited from EV subsidies from the government. And, that was only going to work for so long. And they kind of over-simulated that market. The next two bright spots, and I am going to talk about some others. The next two bright spots, these are some positive developments that have come out in earnings, and this was fairly recently, is that Google and Microsoft both benefited. I mean, you could just see the charts, the direction of Google, which has gapped up to an all-time new high, and of course, Microsoft, which recovered some. Both Google and Microsoft have done exceedingly well, and they have really done well to prop up the tech sector and the tech space. Now, Google announced a dividend for the first time. Now, you're starting to see a lot of these tech companies doing this. We saw Apple coming out with a dividend. So now you see Google or Alphabet doing a dividend. This is now, obviously it hit an all-time new high. Google was up about 12% on its earnings report, which is excellent. I would say that that's pretty incredible considering the price it was already at. But also you see Microsoft, which recovered about 4% towards its high, not making a new high, on having a very good earnings report as well. Now, Microsoft is interesting because it's also benefited a lot from AI, and it doesn't have some of the problems that other companies that we're going to be looking at in a few seconds have, like Apple, which is in a pretty steady downtrend. So let's jump to the market analysis section. And the first thing we're going to look at on my Dash Trader is I'm going to look at AAPL, because I think a lot of our story is here in Apple. So Apple, you can see, I mean, Apple, we were kind of putting Apple in the, in the old General Motors or General Electric category. So goes Apple, so goes the markets. And really, Apple has led technology all through 2023. Apple was on fire. It came back from, $122, $124 all the way up to $200. It did pull back. It did double top, and then it has subsequently pulled back. Now, this could be very easily, this could be, what we would call, a bull flag on Apple. But I would be a little cautious to call this a bull flag. This also could be this would be stage 1, stage 2, stage 3, which would be volatility and a topping pattern. This could also be a breakdown, as Apple has a lot of competition. It no longer is the only, show in the smartphone space, and as a platform goes, they're facing antitrust litigation from the U.S. federal government in the Apple Store. So I mean, they have a lot of legal and regulatory problems. They've have all kinds of issues all over the world. Now, what Apple does have is a tremendous amount of cash on hand, and they still have a phenomenal control of the market, as it's still the biggest and most widely used cell phone platform in the world. But certainly, I think that a lot of the glamour and the upside of Apple is gone. Now, what I also like to point out is GLD. So gold is at all-time highs. Gold came into this very, very important number of 222 on the GLD, which is the gold ETF. And, gold is just doing phenomenally well. And that mainly is due to weakness in the US dollar. So as the dollar gets weaker, as there's uncertainty about the policy of the Federal Reserve, you just see gold, being the beneficiary of that. GBTC, right? We have this is the, the Bitcoin ETF, Grayscale's Bitcoin ETF. I mean, this looks like it's kind of hit a topping pattern. We know that Bitcoin tends to rally and run into the halving. And then sure enough, it once the actual halving comes, once the event comes, buy the rumor, sell the news kind of a thing. And then all of a sudden, Bitcoin starts to fall off. Needless to say, Bitcoin has done incredibly well this year, and GBDC went from, I mean, really, it's ridiculous, $7 up to $64. But we know the crypto space is incredibly, incredibly volatile. So, that's a really nice move already. Definitely would be smart to take some profit in this area as well. Let's take a look at some of the old economy stocks like U.S. Steel. U.S. Steel all over the place. It did make a tremendous run all the way up to 50, but has subsequently pulled back to 37. GE, we mentioned GE has been on fire. You don't expect to see these old economy stocks running up the way they have, but GE has really been in a beautiful uptrend. And even stocks like ExxonMobil, have done very well recently and are at the top of their range. So I would say that definitely these old economy blue chip stocks, are something to there's going to be some kind of flight to safety as money moves out of technology. Technology has made an amazing run. I can't kind of not talk about NVIDIA, but NVIDIA has, kind of come back from really being in correction territory to just about being into correction territory. But NVIDIA was the darling of the AI space. And it just was incredibly overvalued, and it was bound to pull back at some point or another. And sure enough, it has. But I do think that possibly this valuation is not sustainable. This technically is not a good thing to see. It does have that kind of head and shoulders pattern. You do see price getting very volatile and being below its major moving averages. So that's something that you might want to be cautious about. If you are long Nvidia, this might be a good time to take some profit, as anything in the tech space has done exceedingly well. And certainly the value is in the big blue chip companies. Some of them are already kind of gone. They've already left the stable, like GE, and but ExxonMobil is just at the top of its range. And these are things that we definitely want to keep an eye on. USO. USO obviously it represents the ETF for oil of United States oil. It's gotten much better. It's put in higher lows, and sure enough, it could potentially break out here. This is part of the reason why ExxonMobil is at the top of its range as well. Well, needless to say, earnings season is far from over. We're just about, I would say, about 1/3 into earnings season. So we still got 2/3 to go. The trend so far, just to give you a final bit of guidance, the trend so far and what you need to watch out for is that most stocks will meet earnings expectations, but they will guide down on forward guidance. And that is the big concern. It all is about forward guidance and what the Fed does, and the cost of money overall. So please be cautious and be aware. The market has had a tremendous run since October, and that quite possibly this is a great time for you to cash in on some of your winners and maybe move to things that have a little bit more safety. On that note, let me finally switch back. Stay up to date with all things DAS by signing up to our monthly newsletter and emails. Fill out the form at the bottom of our website at www.dastrader.com. Subscribe to our YouTube channel, DAS Trader TV, for DAS Newsroom reminders. Follow us on social media, at DAS Trader. That is on LinkedIn, Twitter, Facebook, and Instagram. Thank you so much for joining me, and trade well for the rest of this earnings season. And certainly be cautious and be aware that the markets have made a tremendous run. And next newsletter, we are going to be covering the sell in May, go away trend, and what the real odds are behind that. But it's always best to lock in some profits if you have them, and maybe put your money to work in something that's a little safer. And safety could be that you just had tremendous gains and you want to kind of diversify into other things. So certainly be mindful of that. Trade well, everybody. See you next time.